Good morning. This is Jim Carpenter. I'm filling in for Rick today for our 10-minute call. And so basically one of the things we're going to be talking about is how to incorporate charitable remainder trusts into your financial advisory practice. And so one of the things is that we want to talk about is we're going to outline. So I'm going to outline for you what I'm going to talk about in the next 10 minutes. One is understanding charitable remainder trusts. Number two is benefits for your clients, how to identify suitable clients, how to incorporate charitable remainder trusts into your practice. I'm going to share with you a case study of a case I did in Northern California, and then some key takeaways. And understanding charitable trusts, they're a sophisticated estate planning tool that allows clients to support charitable causes while providing for themselves and their heirs. And basically, there's two beneficiaries of a charitable remainder trust. The charity is a charitable beneficiary, and the donor is the income beneficiary of a charitable remainder trust. And so one of the benefits, for the clients is number one, it can generate cash flow income stream for our clients. A lot of times people have highly appreciated properties that they don't want to sell because they're faced with taxation. So a charitable trust is a great tool. But one of the key factors when we meet with our clients is to make sure that they really do have a charitable intent. Now, granted, many people don't have a charitable intent until they learn of what they can do for charities, and it's amazing to me how they then start thinking about the charities and the churches and organizations that they're involved in that they really never really gave any thought to. And so what happens is so they're able to reduce their income and estate taxes. And because it creates a tax deductions against their income tax, so many times they can use up to 30% of their adjusted gross income carried forward for 6 years. So it's a great place to be able to utilize qualified assets against the tax deduction and not have to pay taxes as a way of so they get the benefit not only capital gains tax, but also ways to be able to convert assets that are subject to future ordinary income tax when they start doing distributions. And also, many times we've seen diversification of assets, such as property or a stock. Let's say someone's really heavy in just one specific stock, but they want to diversify. But a lot of people just are very adverse to, the taxes and so forth. And also the fact, and then as they learn about how they're able to create this charitable legacy and the impact it can have on so many lives and different things, and still be able to take care of their family in a much better way with less estate taxes. They end up with more, and the charity as well. And so it's an amazing tool. I've been doing charitable trust now since 1990, and I personally have done over 45 charitable trusts myself. And so that's the reason why this is kind of an easy subject for me to talk about when Rick asked me to speak to you this morning. So, so to how do we identify, suitable clients? We want to look for clients that have appreciated properties, people that may have rental properties, apartment complexes, land, and these types of things. And also a lot of times where people have purchased property, they've taken all your depreciation and they get ready to look into go to the next step. And most times they don't necessarily want to go to the next step, but the only way they can get additional tax deductions is to buy up. And that's where a lot of times people are hesitant based upon the market or their risk tolerance or how much they want to be leveraged or whatever risk that they don't do anything. And so and then they go and see their CPA and say, hey, I want to sell this property. Well, this property that's already been through 2 or 3 1031 exchanges, and they find out on $1 million property they have $100,000 basis. So you have all that capital gains tax and possible recapture tax of depreciation of items that have not gone out through their full life cycle, and they have all that recapture tax. And that's the beautiful part about a charitable remainder trust is that you avoid 100% capital gains tax and possible recapture tax. And so there's some great benefits, there. So now they're able to liquidate those assets, and then produce a higher income. And we're able to produce the income by managing a portfolio of securities, utilize annuities, different types of investments that we use inside the charitable trust. There's rules that we abide by. And one thing I've really enjoyed about all the years, after over 30 years in the financial business myself, we've all seen tax laws and changes, and we all know that many times that's driven by abuse. And so we've had to always be constantly adapting to these changes. What's nice about the charitable trust is it's been around, the section 664 of the Internal Revenue Code, and it's been around since 1969. So we have something we can really, to put our teeth into and hang on to and know that it's going to be there. And so long as you abide by the rules, you are totally, there to do the right thing, for your client. And these are the things that we in Camus can help you do, and we'll talk further about that. But so if you have someone that they want to desire, you have someone that wants to desire income, they want to minimize taxes, and and they truly have charitable intentions. I had one trust that I did that we were actually able to, because we had great appreciation in the trust, we were able to access the trust and give to the charity prior to when the people pass away. So it's a great way to provide capital to a charity, not where the charity doesn't have to wait to receive it. And also for estate planning. So a lot of times if people have a lot of money in their estate, and most of the traditional planning, of course, is setting up an irrevocable life insurance trust, getting assets outside of the estate, to replace the asset, for the heirs and to cover the estate tax expenses of the estate. Well, what's beautiful about this is you're actually reducing the estate. And one of the things that I always learned, that always kind of stuck with me, that I share with clients, is that remember this, that you are always taxed on what you own, but you're never taxed on what you control. So most of the trusts that we do self-trustee trust, meaning our donors are in control of those assets. It's kind of like giving away the tree and keeping the fruit, but they're 100% in control of those assets, and they're not taxed on those assets, but they're also be able to enjoy. And so therefore the concept of giving away the tree and keeping the fruit is that they're able to realize, the income. And there's different types of charitable trusts that allow you to be able to defer. If someone doesn't need the income from the charitable trust for say 5 years, there's a provision that we can use to defer that for 5 years, and what we call a makeup account, that they're able to access, at a later time. The money that they didn't take out, they can go back, it compounds and they can go grow. And again, those assets are not part of the estate, subject to estate taxes. So one of the guides I kind of wanted to go through this morning is, here's a step-by-step guide to integrating the CRTs. One is to educate yourself. Feel free to talk to us, to anybody on Charitable Trust. You can do all kinds of research in that. And client discovery, identify the clients with comparable, with compatible financial profile, charitable inclinations. Discuss your CRT as a potential solution. Collaborate with experts. Those are things that we can help you with. We can coordinate with attorneys, tax professionals, CPAs, and we also have a good a relationship with the trust administrator for ongoing administration of the trust. And so let me share with you real quick here. I have a couple minutes. I have a trust that I did for a client in Northern California. They were both in their 85 years old, and they got this property in the 1940s. And due to there's an expansion of an urban growth boundary where they lived, that there was a developer that expressed interest in their property for $8 million. So we ended up doing two partial 1031 exchanges because they did identify properties that they want to invest in. We did a partial interest transfer into the Charitable Remainder Trust, and resulted in $800,000 in cash to the client that they washed against the tax deduction and paid no income tax. Now the income continued to them. They're 85 years old. The income continued to them for their life. Then it passed on to their kids for their life. Then we purchased life insurance on their kids to pass on to the next generation. But some of the areas that I've been involved with, that I've done charitable trusts, just to give you some ideas. I sold a gravel pit, trucking company, and so forth in a charitable trust. I sold a tractor store, Kubota tractors, mobile home parks. Have been great to work with. Apartment complexes. I've done several duplexes. I just closed one about 2 years ago on a duplex. That was very effective. I've actually had clients give me $1 million of cash into a charitable trust. I've sold airplanes in a charitable trust. I've done a machine shop in charitable trust. I've sold just bare land in a charitable trust. The list goes on and on. And of course, public traded securities are the easiest. Mutual funds, individual stocks. I've dealt with all those types of assets in the CRT as well. But anyways, I just want to thank you for taking your time with me. I know this was quick, I'm happy to address any questions you may have or anything I can help you with on a case or how this could be integrated into your practice. And so, so that's, the whole idea is that we're able to help you, attract new clients, help you strengthen your client relationships, enhance your expertise, be able to promote, philanthropy and things that they can do for our world and our community around us. So if there's anything that I can help you with or Rick can help you with, my email, jim@camisadvice.com, or Rick's email is rick@camisadvice.com. Feel free to reach out to me if you like, 480-798-4318. We'd love to hear from you and help you in any way we can. Thank you again for attending this call with me.